Welcome to the Krinzman Property Playbook, your inside look at South Florida real estate. I'm your host, Matthew Krinzman, bringing you real strategies, real insights, and real connections that help you buy, sell, and invest with confidence. With over 2 decades of experience as a licensed realtor and broker associate, I've watched South Florida grow from a quiet getaway to a global destination, and I'm here to help you navigate it like a pro. My business thrives on trusted relationships, with many of my clients being repeat and referrals. This podcast is brought to you by me, Matthew Krinzman, a Sotheby's International Realty agent. For more info, visit buysellmiamire.com. Let's dive in.
Here we are. My name is Matthew Krinzman. I'm the host of the Krinzman Property Playbook. Today, I am joined by Ben Carmona, who is a managing partner at Perch Wealth in Southern California. Where exactly in Southern California are you?
In Orange County.
Okay.
And then San Juan Capistrano.
So you live in a very scenic part of the country and a very nice part of the country. So tell us, a little bit about you. You're welcome to the podcast, first of all.
Yeah.
So it is a real estate driven podcast, Krinzman Property Playbook. I myself have been in the business for a long time, but I'd like to hear what you do and how you help investors or people in the real estate business protect their assets and protect their wealth.
Sure. Yeah, no, absolutely. It's great to be here with you, Matthew. Thank you for the opportunity. Yeah. So my name's Ben Carmona. I'm a financial advisor at broad level, so I'm securities licensed, but I'm not your traditional advisor. I don't do stocks and bonds and mutual funds and annuities and insurance. Like I am a real estate syndications for the most part. And I've been in this world for 20 years. It's really all I know.
Same for me as far as going to real estate sales. I've been 20 plus years and it's like, doesn't feel like it at times, but it feels like it at times. You know what I mean? It's a snap of the fingers, really.
Yeah, boom, bingo, right there.
Yeah.
And I love it. I love what I do. Hopefully you love what you do still.
Yeah, I do. Yeah, I do. Yeah.
So I've been here for 20 years. Today, my company, Perch Wealth, we represent clients, helping them with their 1031 exchange needs.
Yeah.
In terms of finding replacement property. So assuming the audience is somewhat familiar with 1031 exchanges, I work with accredited or high net worth clients that are looking to sell their property or have sold their property, and they're looking to defer taxes via 1031, and we help them find the replacement property. It's important to note that prior to what I say, jumping the fence to become an advisor representing clients, helping them source, the right investment properties, I spent 15 years on the syndication side of the business. So I was involved in every aspect in terms of manufacturing or building the investments that I offer today. So acquiring real estate, doing the underwriting, the due diligence, marketing, management, product structuring, whether it be private real estate investment trusts, DSTs, TICs, funds, you name it. And then also really crisscrossing the country, training and educating financial advisors, attorneys, wealth managers, CPAs on the merits of the syndicated products that we offer. The last thing I'll say, and I'll take a pause, Matthew, is, it's not just me. I have a business partner. We have 10 advisors nationwide. So we're national. Yeah, I'll stop there. Did that, hopefully that.
Yeah, I think so. That was quite intensive. So just out of curiosity, what do you like to do for fun then?
What do I like to do for fun?
Sure. Outside of this business, there's got to be something else, right?
Well, aside from my family, right? I got a young family. I got 2 young kids.
Good for you.
But other than that, it's pickleball.
Pickleball. Wow. That's the rage. Everyone's doing pickleball. Padel is another one. Everyone is like, you got to do it. You got to do it. And I'm like, all right, I'll get there someday. I'll get there.
It's a lot of fun. It's a great workout. That's really what I love to do outside of this.
Awesome. All right, great. So let's get into the whole, I know a little bit about 1031s because I've been involved in a few over the years. Give us the pros and cons of it. Cause obviously there's a pro and con to doing a 1031, doing the exchange part of it. It may not be for everybody. So let's, get into the 1031s and you can lead right into the DSTs at that from there.
Okay. Do you want me to define 1031s?
Yeah.
And then this is broad level. We don't have the time to get into the nitty gritty, but like in In essence, a 1031 exchange, IRC code or Internal Revenue Code 1031 has been around for over 100 years.
Yeah.
Right? And it arguably is, maybe not even arguably, it may be, or it is, in my opinion, the most powerful tax mitigation code in the book. And essentially it allows investment property owners to sell their real estate and defer taxes on the gains associated with that sale, as long as they buy other in like kind investment property for equal or greater amounts. So just example, Matthew, you buy a property for 500 grand 10 years ago. It's worth $2 million today. You sell it. If you do a 1031 exchange, you can roll the full 2 million over into another deal, right? If you don't, you're going to pay whatever 30% taxes on that $1.5 million gain, roughly. So that's the power of the exchange, is that they call it swap until you drop, right? You exchange or swap, and then you die one day, unfortunately. But when you do pass, all of the gains that you've deferred over the 10, 15, 20, 50 years go away, and your beneficiaries inherit that asset at a stepped up cost base. So that's the 1031. We've been blessed. The IRS, believe it or not, has blessed us with this opportunity. They don't make it easy.
No, the IRS is not meant to be easy. That's for sure.
So, we can, that's when we educate and do all that stuff, but that's the essence of a 1031. Now, to your point, it doesn't make sense to do a 1031. From a tax perspective, it always makes sense, or most times, but you have to consider the individual situation. I mean, if you're asset rich and cash poor, you got nothing in the bank. I mean, maybe it makes sense to just pay the tax and make sure you're comfortable. So absolutely, that consideration needs to be in play, and it's totally dependent upon the situation.
Well, the issue with the 1031, like you said, swap till you drop, is not everyone who owns real estate investment property wants to continue to be a landlord at the end of the day. They're like, but the 1031 affords you the ability to shelter their gains for however long until you sell again. But it's like, all right, I sell for $1 million. I can do up to $1 million or over, but I don't want to keep on, nowadays, especially if I'm selling for $1 million, I'm pretty much what I'm going to be able to buy is, for $2 million is going to be similar to what I sold for $1 million, more or less. So what am I getting at this point? And like I said, not everyone wants to continue being a landlord. At a point, it just gets to be a drag, unless it's your overall business. But on a smaller scale, investors, I get it all the time. I just don't want to do this anymore.
Right.
So they sell, pay the capital gains, whatever that may be, 30% or so, depending on how long they owned it or how creative they can get with their taxes and cost segregation. That's a whole other different story. Right. We can get to that. What I've learned, and I guess this is where you come in, as on the DSTs, that's a way where they don't have to keep on doing 1031s, and they can shelter the gains or that, what they earn on the sale for X amount of time, and they're not having to pay taxes on it. So that's one way of stopping, I guess, not having to be a landlord any longer, and not having to keep swapping till you drop, as you said. So if you want to get it, tell us a little bit more, the DSTs, what this stands for and how it helps, investors.
Yeah, absolutely. And thank you. Perfect transition here. So let me just give you, I'll jump into the DSTs in a second, just painting the picture on the environment. And as we discussed briefly prior to the call, demographics, where we are today, right?
Yeah.
Baby boomers and seniors can control a majority of the wealth in the country.
100%. Yes.
And a lot of that wealth is in private real estate that they've worked their tails off to accumulate, manage, right? And grow their wealth. And exactly as you said, Matthew, these groups, my parents, they are tired of active management. And
it's a drag.
It's a drag, right? They're done. They've worked their tails off. They've made it. They just don't want one more call from a tenant, right? Or a property manager. They don't want to deal with anything. Where the 3 T's, I always say, are the tenants, toilets, trash.
Yeah. Toilets, especially at 3:00 in the morning. That's the one. Yeah.
They're over it. And so what do? I mean, confronted with a 1031 exchange, right? 1031s, The vast majority of the 1031 exchanges are done what I would say the traditional way, which is what most people are familiar with. You sell your property, you, with the help of a broker like you, they go out, you find another one.
Yeah.
And that's all great and dandy, but it doesn't solve that problem where you don't want to have to deal with it anymore. Because if you sell multifamily number 1 and you buy another multifamily with Matthew, multifamily 2,
now you have more units.
You got more
creating.
units, you got more management, doesn't do. And so that's what these demographic groups today are thinking, okay, that doesn't make sense because it doesn't solve my problem. And then if I sell the property I've known for 20 years and God forbid I don't find a replacement property, then I'm stuck paying taxes. That doesn't sound like a very good thing.
Right, because you have a certain window of time to identify and then transact on the 1031. So yeah, you're under the gun and you may end up with something you don't want, just to save on the taxes.
100%. And last thing, and then I'll go to the DSTs.
Yeah.
Number 3 is I work with investors all day long. I would say 90% of investors today that fit this profile, their properties that they've owned for all this time, they're earning between 1% and 3% income relative to values today.
That's terrible. You can get that. You're just going to go into the stock market and buy the S&P, put your money into the S&P and your returns far greater than that. So that's not even keeping up with the price. That's not even keeping up with inflation.
Right. And they don't know, right? Because you think your clients, my clients, they're like, I don't want to rock the boat on this tenant. I don't want to deal with anything. So I don't want to raise the rent because if I raise the rent, tenant's going to leave. I got to work.
See that all the time.
So it's 1% to 3%. Yeah. And then if you've held it for 20, 30 years or more, you're fully depreciated. Yep. So you have no more cost basis. And so the 1% to 3% that they're earning is fully taxable. It's horrible. So how do we solve it? One of the ways, Delaware Statutory Trusts, right? And this is just a vehicle that is conducive for 1031 exchanges, right? So you can go buy your direct property. You can go into this passive, which I'm about to explain, structure that also satisfies your 1031 exchange. And so the DSTs were created in the 80s. They weren't set up for 1031 exchange purposes at that time, but it's a structure or a trust whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners.
Wow.
And so when you take this trust and you wrap it around real estate, it creates a situation where you have fractional ownership. You have a lot of the people own a property or property.
So you own shares, and you're owning shares essentially, in a way.
Essentially, yes. You own an undivided interest in this trust, but yes, in a way. And in 2004, the IRS actually came out and validated this trust or this structure as real property ownership, and therefore eligible for 1031 exchange purposes. Okay?
Right.
So they've been around for 22 years. All right, let me give you, what is a DST now? Okay, that's great. You talked to me about the entity. I'll give you an example. So in our world, there are sponsors, real estate sponsors, or syndicators, if you will. And I'm going to name some big ones, just hopefully your audience will be familiar. Starwood, Invesco, Ares, Apollo, Cantor Fitzgerald, Inland. There's about 55 active participants, but they're some big players. So they're legitimate. These folks go out and use their capital, their resources, their relationships to secure institutional quality real estate. It could be $100 million multifamily property in Texas, $50 million self-storage portfolio in Raleigh, North Carolina, $200 million medical office campus in Orlando, Florida. Whatever it may be, all different shapes, sizes, sectors, and whatnot. They buy it. They hire on the third-party property management. They do the asset management, meaning they pay monthly distributions to investors. They send out quarterly performance reports to investors. They send you your end of year tax report that you can hand to your CPA. And so these assets, these DSTs those properties are acquired already. They're stabilized, income producing, they're owned. So Matthew, you sell your property tomorrow and you don't want to manage.
Yeah.
You could take your $1 million of equity and exchange into one or more of these DSTs. And the last point I'll say, and then I'll stop, is going back to up to 499 beneficial owners. What does that allow for? The minimums are low on these. So anywhere from 100 to 250,000. So it's not about, and this is as an advisor, yes, I can, through these DSTs that are 100% passive, right? You can solve that problem, but you can also mitigate risk via diversification. So Matthew, you can put 250 in the healthcare, 250 in the storage, 250 in the single tenant triple net portfolio. We can mitigate risk, take you from active to passive management, more times than not increase income, and also add back depreciable basis through debt, non-recourse debt. But I'll stop there.
Gotcha. So these vehicles are set up, they're known as DSTs. Is that the Delaware Sales Trust? So if I were to sell my property for $1 million and I came to you and said, Ben, I don't want to do a 1031. I want to shelter my gains. Here's $1 million. What do you do with that?
Well, you would want to do a 1031. These are 1031. Like
Okay.
if you told me you don't want to do a 1031, that means that you're going to cash out and pay the tax.
Gotcha.
If you tell me, Ben, I'm selling a property, I do not want to manage anymore, I don't have a suitable replacement property to do my own 1031 exchange, can you help me? And that's where we come in.
Great. So that's where you come in, and I would come to you and you would advise me or anyone else saying, hey, here's your options as to what you can invest in.
100%. I am like you're a broker on the direct real estate side. I'm a broker in the DST world. And that's very important because so many folks are sold or buy into the premise of what we're offering. It's amazing. What do you mean?
Yeah, sure.
I don't have to do anything anymore, and I can get into this institutional quality real estate, and you can increase my income, blah, blah. Well, yeah, this all sounds great, but you need to understand what you're going into. Just like any business, there are good and there are bad. Now, I want to say this before I forget, because I talked about all the benefits. The downside, right? And this is a big thing for some clients is these are illiquid assets, right? Not to say that most of our investors, they buy real estate, they're long-term holders. But if they needed cash, they wanted cash, and they own the property direct, they can just, hey, I'm going to sell it. Right, Matthew.
Right.
Come out here and
tap into and get liquid pretty quick.
These DSTs, that is not the game, right? You are a undivided fractional owner. You may be a 5% undivided owner in this $150 million Amazon distribution facility, and the trustee of the trust makes those decisions. So anybody that goes this direction, they need to be comfortable being locked up for 5-7 years.
I got you. Just one quick thing. There's the Delaware Sales Trust. Is that separate from a deferred sales trust?
It is.
Because I've heard that. So, that's where sometimes the acronym is the same. So people there could be confusion on that. So I just want to help, clarify that they're not the same thing. Correct.
I think those deferred sales trust guys piggybacked on the DSTs,
I got
a little wind in their sails. No, yeah, you're right. It's so confusing. Totally different vehicle. Still 1031 eligible. There's some other benefits and downsides to that, just like DSTs, but just totally different things. Yeah.
So say I know a syndicator here locally, they're raising capital. They're doing, do they have to be set up as a DST, or can I just put in with them and say, hey, I'm selling my property. I want to invest with you, and whatever the payouts are, the payouts are, whatever they have, their structures, I can do that, correct?
Totally. Absolutely.
Awesome.
Right. I mean, there's a lot of syndicated deals out there that aren't structured as DSTs and distributed through the financial advisor community. You could be doing it. I could be doing, we put our own deals together and have some, typically those are TICs, tenant in common.
Okay.
Yeah, totally. Those are eligible too.
Okay. Good to know. So there's a structured and alternative investments in real estate, correct? And we have private equity, debt funds, opportunities. There's what other, explain that, because that's now I'm getting a little bit over my own head.
We hit on 1031 exchanges, and the DSTs are fall within the alternative investment basket. What are alternative investments? So there's and they're becoming popular. And again, this is my world. Basically, alternative investments are investments outside of your traditional investments, stocks, bonds, mutual funds, like in insurance, right? So any private equity, private debt, private, real estate funds or oil and gas, there's all these different investment opportunities that the majority of investors are not familiar with because their advisors are not familiar with. And just to, I'm very passionate about this because of the value that alternative investments can bring. And I'm just going to give a backdrop again, if you don't mind.
Sure.
go back to 2008. Everybody that did everything right, right? They followed the traditional portfolio model of 60% equities, 40% bonds, right? And then you're like, wait a minute, I did everything right and I'm still in bad shape. This is horrible. What's going on? But then to your point, who did okay? Who did well? And it was the big boys, of course, the institutions, the endowments, all these are the big money. And then you look in, you say, okay, well, what these guys do? I mean, if they did so well or they withered the storm, then like today, they had 30, 40, 50, 60% of their portfolio in alternative investments, investments that are not tied to the stock market, or the bond market, following them, seeing that historical performance and how they operated and how the everyday average peon like me out here does. There is real value in incorporating alternative investments. And then I'll finish after this.
Sure.
Here we go in 2025 now, Matthew, right? Nobody ever thought they'd recover after 2008.
No, that's true. Oh my God, that's so true.
Right? They're 15, 16 years older and they're back. Of course, stocks are back. Real estate for the most part is back. Bonds are back. And you're thinking, if they're thinking, I do not want, and they should be thinking, I do not want to repeat 2008. I do not want to deal with that. What can I do?
I don't want to go through that.
And so that, to the audience, and of course, you need to be selective in what you invest into, but to the audience, if you're over allocated in stocks, bonds, mutual funds, if you haven't adjusted your investment strategy after 2008, you just been riding the wave, it's fantastic. But now is the time to think about incorporating some assets that reduce the volatility, increase your passive income, increase your tax advantages, if you will.
So this is where we're getting into the balancing the capital preservation and invest and in creating income generation at the same time. Is that it?
Sure. Yeah. And you may do these, Matthew. I'm not sure. I mean, if you have a fund and you're out there, you buy a few multifamily properties, you could do it yourself. Investors should invest in that. That is outside of the stock market. You're in a diversified portfolio, income, so on and so forth. Yep.
There's a balancing act between a 1031 and buying more property or coming into the Delaware Statutory Trusts. I come to you and say, Ben, I'm kind of on the fence. How do you help me or help anyone else kind of figure out what's going to be the best course of action for them? Hey, go buy more real estate or do a DST, invest in that, and then I guess, because like you said, it's liquid versus liquid. Well, although you have to liquidate a property. So how would someone like balance that, decide really how do you guide them through that really to make that decision?
Yeah. Before even looking at the investments, I'm looking at number one. I mean, look, if it's an 85-year-old couple, and they more times than not, unless they're still shaking and moving, wanting to be involved in management, the DST makes a lot of sense. Or, those same folks, I'm like, I don't want to pay the tax, but I don't have any cash in the bank. In those cases, I'd say, like, why don't you just cash out 50% of it, pay the taxes? You can defer some of the taxes. If there's somebody that is 50, 40, they're still shaking and moving. And I know you are going to be unhappy in these deals. You have control. I mean, you have no control.
That's very honest. I appreciate the honesty on that. That's a very honest answer.
If they don't have control and they're still moving, I don't want them to go in these deals. I'll just say, look, use it as a backup plan, right? Use Matthew. You guys do your best to find a property that you like and that you want to be involved in. God forbid you cannot find it. You can come back to me on day 44 and I can take care of you and defer your tax.
Just on these DSTs, is there an income being produced? Are they getting a check like a bond, like a clipping a coupon or a dividend every quarter? Are they getting paid out on quarterly basis? Quarterly basis?
Sorry, I didn't even mention that. Absolutely. I mean, these are all income, anywhere from 4 to 8% annual income rates, and most of them are paid monthly. And of course, that range depends on the sector and the location, the type of property, but they're income producing for sure.
Gotcha. And if someone wanted to liquidate their investment in the DST, is that a fairly simple, like me, like going on like my stocks, just sell, or does that take a little bit of a process?
It's not even a process. Going back to your liquidity, it can happen, but it's highly unlikely. And I'll tell you, if you're in a deal, if you go into this trust with me, Matthew, and you
Sure.
say 3 years, I want to get out. Okay, well, if you or I bring a willing, able buyer to the table that wants to buy your illiquid position in this trust, we can facilitate that transfer of ownership easy. The fact of the matter is the chances of bringing those folks to the table are unlikely. There are vultures, if you will, or creditors waiting for somebody that needs to get out because they'll come in and buy you out at a 40% discount.
Sure. It's like those insurance people, they'll buy your insurance, your life insurance policy, pay you 60 cents on the dollar or something like
Exactly.
that. Yeah.
I don't want anybody on this call, if you go this path, and if you go this path, there is no, I want you and every client that I speak to understand that you're stuck for 5 to 7 years, period.
That's great. This is important information because, you don't want, the honesty is tremendous here because, there's a lot of people, this will sell you anything just to get the money, right? Make the fees. So it's, the churn and burn type of deal. But this, you have to make clear to the investors this is not a 30-day, investment. This is something you can't cash out. You have to wait till the fund basically is closed or the trust is closed out by the company that started it, that provided it.
That's exactly right. That's an important point. So the sponsor company, right, that put the deal together, they're managing it. They will sell it at some point. It could be 3 years. It could be 5. It could be 8. But somewhere in the and then you could do another exchange, right? So that isn't the end of the road. And so we have some guys in that example that I gave you, a younger guy, Matthew, that's working with you that says, gosh, I do not want to be stuck. This is boring to me. I'm not excited with a 5 or a 6% income. You have to kill me before I jump in that thing. But you can't find them. You end up not finding a property. So he reluctantly goes in to these DSTs. When they sell, she can get back into you can do another 1031 exchange back into direct real estate. So it's not the end of the road when you go into DSTs. You can do another exchange back into direct once you're out.
This is good information. So we kind of covered all this. So we're covered the benefits and the risks because of basically them being liquid versus liquid, who they're better suited for. It's not necessarily the younger investor necessarily, although maybe they're just, like you said, maybe they're happy with boring, and just collecting a check every month. It's kind of set up really for someone who has been in, his own real estate investment for a while, no longer wants to do it. They're older, say they're getting closer to retirement age probably, or in retirement, and they're looking for just to create a income on top of whatever else they're making on a monthly basis. Hopefully they're just not relying on Social Security because that's a dead end, obviously, for most people. They've made other good investments with their lives, and this is one way to continue getting a monthly check that goes along with their, it covers their expenses or their income for the month, and they can do whatever they like with it. And then eventually when Starwood says, hey, we are going to close this now and we're going to sell it off. And then everyone gets back their money. And I guess, is there a profit? They get profits on that, whatever they sell for?
Yeah. So there's no guarantees again, like on the income or the value. The goal is absolutely you get income along the way. And when they sell, you get your pro rata share of the appreciation or profits on the back end.
Excellent.
Right?
When you're evaluating this, there's metrics involved, obviously like evaluating a piece of real estate investment, like there's cap rates, there's expenses, internal rate of return, and all that other good stuff going on. Or when you're buying a stock or bond, you have your dividends, you have your ratios to deal with. What are the metrics that matter the most in a DST?
Yeah, it's interesting. This is a foreign world. I don't care if you're the most sophisticated real estate investor in the world, attorney, CPA. When you walk into this world, it's a different ball game. And so, yes, all the traditional metrics and figures and market data is important. But in this world, there's so many other variables, one of which always starts with the sponsor company, right? The sponsor. And it doesn't necessarily mean the bigger are better either.
True. Very
right?
true. Very true. Yes. You're
so
right.
I want the sponsor, of course, to be experienced, not only on the real estate side, but also on the syndication side, managing retail investors, right? Just because Starwood, and this isn't a knock, it's done incredibly well institutionally, when they come down to this level and deal with our clients, it may not be a great experience, right? They just they don't know. They're good real estate guys. But beyond that, experience, the track record, wherewithal, their commitment to the space. So the sponsor is very, very important. And then when you get down to the structure, I would say is, the fees, of course, the front end fees, the operating
like a
fees,
mutual
the
fund.
back end fees. Those are all critical areas. And then I'm also looking at, the viability of the investment strategy. There's a lot of stuff, and you kind of hit on it earlier. There's a lot of stuff out there that I say is built to sell, structured to sell, meaning looks beautiful. How can I lose on this thing? Oh my gosh, amazing. The average layman, right? Not even the average. They think this is amazing, but they don't understand, the limitations or the structural limitations with DSTs and how they can refinance. And so I'm looking at the sponsor, I'm looking at the real estate, of course, or the structure of the investment, the market, and then the viability of the investment strategy. I want to make sure that investors, and you can never be certain, I want to make sure there's a viable path to returning my clients money at the very least back 5 to 10 years, collecting their income and hopefully appreciation at the.
Awesome. So we talked about diversification. This is one way for investors to have some diversity or diversification in their portfolio along with stocks, bonds. When should an investor consider it, to come into a DST?
From like a diversification standpoint? Well, it's great. I'll give you I'm in Southern California again.
Sure.
And many people out here are fleeing, right? They're just running. They want out.
I've heard rumors. I didn't know if that's true or not, but
it's true.
It's true. I know it's true. Yes.
So they're selling their properties, but again, traditionally, if they sell their property in Manhattan Beach, they could hire a broker or buy a triple nets in wherever, somewhere in the country, but
a Dollar General in Oklahoma. Sure. Sounds great.
Yeah. It's kind of scary. And so for those folks, these can be great. Like, how do I diversify? Or you have a big concentration of real estate in California or any state for that matter, and you want to start spreading it out. Maybe you're concerned about earthquakes or fires or hurricanes or you in Florida insurance. So DSTs can be used for that. But I just think the world that we live in today with a dozen wars on the brink of breaking out.
Sure.
Who knows what's going on anywhere anymore. And the power of being able to sell one asset that may represent 20 or 30 or 40 or 50% of your net worth and take that and break it up, not only by geography, but also by sector, right? You can have storage and healthcare and multifamily. Hotels. That is the power of diversification. And that's one of the benefits that a DST allows you to do.
Awesome. Tax advantage, when you do strategies that are for tax advantages and maximizing the long-term returns, what are overlooked opportunities? Is there anything that's being overlooked? How do they compare to traditional investments? Just putting in, let's say I have an IRA or a Roth or if I'm, self-employed 401ks.
Well, are we talking DSTs specifically?
Yeah.
Or, okay. So
the
DSTs,
advantages. Yeah.
Yeah. Well, look, you got to look at your whole comprehensive portfolio, right? It goes back to if somebody has most of their capital in a 401k and they have this real estate project and they don't have cash, that is going to play into my recommendation. That could mean that, hey, look, you need to bite the bullet and take a few $100,000 off from the exchange and put it in your bank. You got no money.
You got to have a cushion.
And you exchange the rest. But so you have to look at the whole comprehensive picture. Yeah, that's what I'd say. Now, I just want to bifurcate that the DSTs are 1031 eligible only. They, as investment strategy, I would never tell a client to invest their K assets or cash into a DST ever.
Okay.
Ever. It just doesn't make sense. I mean,
right.
I put that money in exactly. It stinks. It doesn't make sense. We have investors. You can invest cash in DSTs. But I say, look, if you have cash to invest, I want you to go into this fund, or this fund, because the income's better, the fees are less, and your risk is less because you're diversified. We're not going to put DST. They're great for your 1031, not necessarily for your cash.
Got it. So not if you're cash heavy. That's not one way to do it.
We got
But
other stuff. Yeah.
obviously, it's
Lots
just
of
with a
stuff.
1031 is really that's really where its advantage comes
Mhm.
into play. So we're looking at anything, any opportunities? Like I asked that question
Yeah.
just a little bit ago, but is there anything, opportunities that are being overlooked here at all?
I mean, there's a lot, I can go on
Give me
tangents on
one.
Matthew. Okay. I'll just
Give
give
me
you one.
give me one.
Let's
Yeah,
just say, and this may be relevant to your business too.
sure.
Or let's, in the DST world, right? You got some DSTs have leverage, some don't have leverage. And obviously that leverage, and we didn't get into it, can be, or is very important for satisfying an exchange in many cases, right? You need to replace it. But there are folks that are selling property today that, their leverage is super high, right? It
Yeah.
could be 60, 70, 80%. And there's not many options, right? The banks have tightened up, and how do you replace that debt? There are DSTs that are structured. They're called zero coupon, and they're called zero coupon because they don't pay income. But I'll just give you the example. It could be this last one, $1 billion portfolio of Amazon distribution facilities, right? On a 20-year absolute net lease. And so what the DST sponsor does is 3 Amazon distribution facilities, they get 85% leverage on that portfolio.
Wow.
And so the income from the Amazon rent payments goes to paying down principal on the loan. So somebody, let's say your client sells sells a $5 million property. I'm just making this up, and he's got $3 million of debt to replace. And you're like, dang, that's tough. I don't know if we're going to get 60% from the bank. I don't know if we make this deal work. You could call it $500,000. I'm making this up, and put it in this zero coupon deal. And that 500,000 will get you the 3 million of debt that you need. And then your client can take the remaining 2 million or 1.5 million of equity and buy another property debt free, if that makes sense.
Sure.
Or because look, if you have to replace debt in an exchange, you're going to have to go to a bank, right?
Right.
And you go to a bank, which is a pain in the butt. You're also going to be on the hook for that debt.
Yeah.
You can get the debt through a high leverage DST that's very secure with a 20-year lease with Amazon. The debt to the client is non-recourse. You don't have to go to a bank. You don't need to get pre-approved. You can just get it immediately from an exchange standpoint and take the balance and buy whatever you want. Does that make sense?
Yeah, no, that's interesting. Yeah. So then I have 1.5 million. Let's say, like you said, I have 1.5 million to go buy something for cash. I don't have to worry about the debt. And actually that helps really with the carrying costs every month, because then your whatever your return on investment is pure, there's no debt service. And then you have that $500,000 in this DST, although it's zero coupon for now, but whenever they close out that or they sell it off, you're going to get the appreciation on that $500,000 you invest, hopefully. But we have to put the disclaimer, hopefully.
Yeah.
But the likelihood that you will receive the appreciation on that 500, and I still have that asset for 1.5 million that I paid, is probably appreciated now in the last 5 years or so, or how long I've been in this DST.
Right.
My $500,000 has gained some appreciated. I'm ahead. You've done well.
Easy. You're no longer on the hook for debt. It's been satisfied. You defer your taxes via 1031 exchange. Again, it's a convenience.
And if I want to liquefy, once that DST closes out, I have whatever that money from. I have to pay a little bit of tax. It's fine. I don't care. Then I sell this one for $1 million. The property. I'm sitting on a bunch of cash at an older age. Let's say I'm a retirement age. Yeah, you have a nice cushion to live. You have a nice cushion, and you obviously can use that money still to invest in other things or whatever else you want to do with your life, right? So that's a big plus. I like that.
Amen. So
Yeah,
I don't know.
that.
Hopefully that came through to the audience. But
no,
there's a lot of things we're able to do. But that's one of them.
Yeah, look, it's just another piece of the puzzle. Like we were talking before offline, it's just there's so much in real estate, just beyond just buying and selling real estate.
Right.
There's all these other vehicles and ways to invest in it and gain from it. Hopefully you make a profit, you're making a monthly appreciation or whatever you're investing in, but there's other things than just owning a physical asset. You can be a part of the DST. You can be You can invest in REITs. You can do whatever you like, in triple net properties, like you said, TICs, tenants in common type of deals, or syndication. So there's so much available to people out there. It's just really having someone who can explain it and in a way that it's understandable. Because it's really at times, like I said, I've heard of DSTs, Delaware Sales Trust, and I've heard of Deferred Sales Trust. You help clarify the difference between the two a little bit. I mean, I think now we shed some light. They're not the same thing, people. So whoever's, right. I was under the impression they were the same thing. So I just, now thankfully I know they're not. And it was a Delaware sales. Now, hopefully, like I said, this podcast is to help people. So if someone learned a little bit of something about this, today, and they are now hopefully a little clearer as to what a Delaware sales trust is versus a deferred sales trust. Whoever is watching this and listening to this is why you need to talk to someone like Benjamin and understand the differences and the ways to protect your assets. And you'll tell them straight up, hey, this is the best way, or this is not the best way for you to do it. How do we find you?
Yeah. So you can go to well, I'll give you my cell phone. I do this every 818-269-4972. Call me. I will absolutely call you back. Or, go to our website, www.perchwealth, Perch. It's not after the fish. View higher ground, Perch Wealth. And we got an amazing team. So whether it's me or somebody else, but feel free to call me on my cell.
And you guys have a YouTube channel too. I see that's so you put content out on there as well.
Yeah, I know.
And you're out in Orange County. So remember, when you're calling Ben, you're in Eastern Standard Time, there's a 3-hour difference. So don't call us. Don't call when it's 9 o'clock in the morning our side. I mean, if you're up at that time, you have kids, so you may be getting up at that point.
My team in Florida, they don't adhere to those rules anyway. So
do you have people? You have
two advisors in Florida and Georgia and New Jersey, California, Arizona. We're all over the place.
You have a great reach around the country. So they're reachable. All right, Ben, it was awesome having you on. I appreciate you taking the time to explain Delaware Sales Trust, what the pros and cons of all of it is for someone who's looking to shelter their money or when they're doing a 1031 as an option to do a Delaware Sales Trust. I want to stress that as a way to protect your gains. Anyway, thank you. I really appreciate it. Joining me on the Krinzman Property Playbook. Whoever is listening and watching, hit the subscribe, leave a comment, give us a like, reach out to Ben, reach out to me. We'd love to talk to you. Thank you very much.
Thank you, Matthew. Thank you, guys. Bye-bye.
That's it for today's episode of the Krinzman Property Playbook. I hope you've gained some valuable insights and feel inspired to take your next steps in the real estate game. If you're ready to make a move or need expert guidance, let's connect. Whether you're buying, selling, or looking to invest, I'm here to help you navigate the South Florida market with confidence. You can reach out to me directly through my website or on social media. Let's get the conversation started and make your real estate goals a reality. Thanks for tuning in, and I'll see you next time on the Krinzman Property Playbook.